Hey guys, how's it going? It is Sunday, July 12th. It's almost 2 p.m. in the afternoon, and just making my weekend update video to talk about my potential plays or what I'm thinking about for this coming week. And also in my previous video, one of the viewers has asked if I could make a video talking about how to calculate cost basis. So I'll talk about that at the end of this video a little bit as well. But I really don't have a good plan as of right now for what I want to play, if anything, for this coming week. And as I stated in my prior videos, a lot of bank stocks are having earnings this week. So I think the market is going to react violently in either direction. I think it's either going to be news that's worse than expected and that stocks are going to drop very rapidly, or ETFs like IWM, which is very heavy in the financial sector stocks, will also drop a lot. Or I think that the numbers when they come out are not going to be as bad as people expected, and that stocks may actually go up by a lot because they may rally really hard on good news. So I might just stay cash for at least Monday or Tuesday, because I believe the first bank stocks have earnings on Tuesday. So I may be cash going in, because if the first couple earnings are bad, then I'm probably going to assume that the rest of the bank stock earnings are bad, or vice versa. If the first ones are good, then probably the other ones are going to be good as well. So that being said, because there's a lot of potential volatility or fear, the option premiums for IWM and the bank stocks are going to be very high. So I did look at the IWM option chain, which I'll show you in a second, but I also was just looking at this heat map by the end of day Friday, just to see if any stocks that I was interested in were kind of beaten down on Friday and then might be due for rally, or if they were deep in the red, maybe that would be a good opportunity to open up a cash secured put on them Monday morning, so that again I can get in at a lower strike price option. So the one that really caught my eye was AMD here, and you can see compared to the rest of the semiconductor stocks, AMD was down 2.4% on Friday, and I think some of that was expected, like I said in some of my previous videos, because AMD did rally very hard the days before, all the way up to $57 or so. And so it was due for a pullback just because of profit taking, I suspect. So if AMD is a little under $56 right now, it might be a good opportunity to sell a cash secured put on AMD. So let's just take a quick look at the AMD option chain. And I haven't played AMD in a while, and when I did play it a few weeks ago, a month ago, it always has been good to me. So I might look into getting into AMD again. But as you can see, it had a decently red day on Friday. But if we look at the weekly chart, you can see it really took off from about $52 and some change all the way up to $57. And then, like I said, I suspect some of this drawdown is probably from profit taking. But also, I showed you on my video on Friday that AMD calls were very popular options. You can see third most popular option on Friday. There's another one here. So that tells me, or I suspect, that people are still bullish on AMD. So AMD could go even higher. So that would be a good opportunity for me to open up some puts in terms of selling puts on AMD. So if AMD does go higher, well, then I could hopefully collect risk-free premium. So right now AMD is at $55.93, so just shy of $56. And for me, I still want to play it safe this week, just because, like I said, I think there's going to be a lot of volatility in the market with these bank stock earnings. So I want to, again, get in at like a 0.4% return on risk, just so I can play it safe. And also, if AMD does drop, if the market does drop overall, I'll get assigned shares at a lower price than if I played a little bit more risky option. So that would put AMD, I think, at around the $51 strike price. So let's just see. $27, which would be the premium that I would collect, divided by $5,100 in collateral, right? Because it's $51 per share, and every contract is 100 shares, so 51 times 100 is $5,100. So if I divide those two, I get a 0.5% return on my risk. So I suspect 50 is going to be a little less than 0.4. So $18, same thing, divided by 5,000 this time, because it's $1 less strike price. Yeah, so it's 0.36. So probably looking to getting the 50 or 51 strike option in terms of selling puts Monday. But again, nothing is written in stone yet. Let's see what the after hours trading does this evening, and more importantly, let's see what pre-market is looking like tomorrow morning, because again, these numbers are going to change once the market opens. But as of right now, I'm looking at maybe the 50 or 51 strike put for AMD to give myself a decent cushion in case there is a big drawdown in the market. But again, AMD is in the semiconductor sector, and in general, that sector has been doing very well. I mean, if we take a look at SMH, which is the semiconductor ETF, the Van Eck semiconductor ETF, you can see it's been rallying hard the past few days from a sort of low at 146. And when I say low, I mean like for the past few days, not an all-time low or anything like that. But from about 146 on June 26th, all the way up to 160 now. It actually hit all-time highs now at 160. So you can see it had a pretty good run up for the past few days. And actually just looking back at it, I mean, here's the more of a broader view of that ETF. You can see this was pre-pandemic, had a big drawdown. I would have loved to have get in at around 96. That would have been amazing because you would have almost doubled your money. Up until now, it's at 160. So again, we hit all-time highs. And I'm very bullish on the semiconductor sector in general, just in terms of as a long-term play, because I believe in the future, we're going to have more and more need for microchips and processors and things like that. So I really think the semiconductor sector is going to be a good long-term play. But I would love for another market correction so that I can get in at a low price and then maybe sell covered calls on the way up, in addition to collecting stock appreciation for more of a long-term play. So if I do end up getting assigned shares of AMD at 50 or 51, I'm going to be okay with that, because again, looking back at the stock chart for AMD, every time AMD has broken below 51 or $50, I mean, it's broken 3 times since, let's see, this was May 1st. So in roughly the past 2.5 months, every time AMD has broken below $50, it's immediately come right back up. And you can see it's been trading ever since, let's say, roughly April 24th, or the end of April. AMD's been trading in this range of about $57 and $49. So it's been going up and down between that kind of 50, like low 50s to high 50s range. So one thing I am concerned about is that right now we're kind of in the higher 50s range. So that tells me AMD might have a drawdown. But like I said, if I sell my put at 50 or 51, that means I'll get in, if I do end up getting assigned shares, at the valley of its range. So that tells me that if I do get assigned shares in the $50 or $51 stock price, then there should be move upwards again. There should be room to grow for AMD again. So if that's the case, and I get assigned shares at 50 or 51, then I could, ride that stock up, hopefully back up to the high 50s, get stock appreciation, collect premium along the way by selling covered calls, and then make some profits that way. So just as an aside, because someone had asked me how to calculate cost basis, in this example, let's say I did sell a cash secured put on AMD at $50 at the $50 strike. And let's say on July 17th, at the end of the day Friday, AMD was trading at $49. So it was below my $50 strike. Well, that means that I'm going to get assigned shares at $50. So that means that my cost basis is $50 a share, because that is essentially what I paid for the stock. All cost basis means is how much did you end up paying for the stock. So in this scenario, if my strike was $50 and I got assigned shares on AMD, I'll just draw some notes here on the side. That means that I own AMD for $50 a share. However, that is not entirely true, because by selling a put at the $50 strike price, you have to remember you collected money for that. So I collected 18 cents per share of premium value. So although you paid $50 a share for AMD because you got this option assigned, you actually collected 18 cents per share in premium, right? Because this is the per share price. I say $18 because that's overall for the 100 shares. So, well, in actuality, your cost basis is going to be your strike price here, which is $50 per share, minus your premium per share, which in this case is 18 cents. So actually, your cost basis is going to be $50 minus 18 cents. So just to do some quick calculation, $50 minus 18 cents, your cost basis is actually $49.82 on AMD. So that's how you can calculate cost basis for any cash secured put you decide to sell if you get assigned shares, because you're going to pay $50 per share once that option is assigned. However, you did collect money for selling that option. So you just subtract the two numbers, the strike price minus the premium collected per share, and that is your overall cost basis. So if that's the case, and let's say Monday morning, I sell this cash secured put on AMD at the $50 strike, and then on July 17th, at the end of the day, if AMD is trading at $49, that means I'm going to get assigned 100 shares of AMD at the $50 strike price, but I'm going to collect 18 cents per share, and so my overall cost basis per share is only $49.82. So I'm just going to write per share here. So this is the power of options, because let's say in a normal world and where you're just buying and selling stock, let's say when AMD was $50, let's say midday Friday, you decided to buy shares of stock at $50. Well then, because you just bought out stock flat out, your cost basis is exactly that. It's $50 because that's what you bought it at. You just bought shares. But by selling an option and collecting shares that way, your cost basis is actually a little bit less because you collected money for selling that option. So that's the power of selling option, is that it's one way to also decrease your cost basis. And another way to think about it is that you're buying shares of stock on sale or with a coupon. This is your coupon. The premium you collect is your coupon. So let's say now in this scenario, you did get assigned shares of AMD at the $50 strike price. Now I just told you that your calculated cost basis is $49.82. Well, now the following week, and again, these numbers, these premiums are not going to be accurate because they're going to change with time as the weeks go on. But let's just say the following week, you now want to sell a covered call. So we're going to sell a call. I'm going to erase these so it doesn't get confusing. But now you're going to sell a call. And you can sell a call now at the $50 strike price. And that's actually going to be better than break even, because break even for you would be $49.82 per share. So let's say you were to sell this covered call at $50. So that means that now you're going to collect, and again, these numbers are not going to be accurate. They're going to change with time. But let's just say you're going to collect $643. Again, this number is not going to be accurate because in our scenario, $50 would be out of the money, but where the stock price is currently, it's in the money. But just for argument's sake, I can show you on the screen. I'm going to use the value that's shown on the program. So you're going to collect $643 in premium for selling this covered call. And if AMD goes above $50 by end of day July 24th, that means your shares are going to get called away. So that means you're going to end up selling your 100 shares for $50 per share. So just to make it easy, I'm going to make this $6.43 because that's what the premium is per share. So we're going to talk about it in per shares. And you're going to sell them for $50 a share. So I'm just going to write that here as $50 per share. So if you remember from our earlier example here, your cost basis is $49.82. And now you're going to sell the shares for $50. So right off the bat, $50 minus $49.82, right? Because that's what you essentially own those shares for. is 18 cents in stock appreciation, or you can think about it as stock appreciation, but it's not really, right? Because you bought them at 50 and you sold them at 50. Your profit, probably that's a better way to put it, your profit is 18 cents per share times 100 shares, right? Because you sold one contract each time. So that's $18. So I'm going to put $18 here on the side. So you made $18 just by the buying and selling of stock, by selling your covered call and getting the shares called away. But you also made $6.43 in premium by selling that option. So again, this is not going to be accurate because these numbers are going to change and it's not going to be this high. But I'm just using the example that's shown on the screen just so it makes sense. So that means now that your total profit is going to be $18 plus $6.43, or more accurately, $643. So I'm just going to do $18 plus $643 because that's total for the 100 shares. So in this scenario, and again, these numbers are way too high. They're not going to be accurate, but just for the math, you would have made $661 after completing what now has become one full turn of the wheel. So that's how you calculate cost basis. You take your strike price that you sold your put on, you subtract from it the amount of premium per share, and that's your overall cost basis per share. And then when you sell your covered call, you take your strike price and then you're going to add to it your price or your value of premium. And then that's going to give you your total profit essentially for that whole run of the wheel. So I hope that made sense. If you have any questions or comments, as always, leave them below. But the other possible option, and I probably won't play this, but because the bank stocks are going to have a lot of earnings this coming week, and because IWM, the Russell 2000 ETF, is made up of a lot of financial stocks, the premiums on IWM are looking really juicy right now. So I'm just going to erase this, but I'm going to erase all this as well. And if you take a look at the premiums of the option chain on IWM, it's very high. The at-the-money option is a little under 2% in terms of return on risk. So if I went to sell a put for this coming Friday right now, and again, these numbers are going to change come Monday morning, but again, just to play it extra safe for a 0.4% return on my risk, I could get in at probably the $133 strike price, because let's say 133 is $63. So 63 divided by 13,300, that's 0.5%. So I'm going to suspect 132 is probably just under 0.4. Let's just see, 51 divided by 13,200. Yeah, so just under 0.4. So between 132 and 133, I could sell either of these and collect a roughly 0.4% return on my risk, which is not bad because it does give me a large buffer from where IWM is currently trading at. So it might be worth looking into. The one thing that I don't like about IWM right now is that it's, for the time being, trading under the red Ichimoku cloud, and also on the RSI, it's a little bit more overbought than oversold. So that tells me that IWM might have, it's very hard to say, but it might have somewhat of a bearish trend going on right now. But we'll have to see. The DMI is not really helpful in this scenario as of right now. It's not really, doesn't really have any momentum in either the bullish or the bearish side. But we'll keep a look at IWM, not because I'm bullish on the bank stock earnings, but because of the premiums. They're giving me a good $9 or so buffer in terms of my 0.4% return on my risk. So if that is the case, you know, getting options or getting stock assigned on IWM at the low 130s might not be a bad idea, because it has been trading again in a range in the past few weeks from about 134 to a high of 146. So if I could get in at 133 or 132, that wouldn't be bad. And also because 133 is pretty much right at the 61.8% Fibonacci level, that might act as a pretty decent support for it. So that's something to look into. I'll keep my eye on AMD. I'll keep my eye on IWM. But again, nothing is written in stone. I really don't have a good outlook on this coming week. So I may just end up being cash for Monday, maybe even Tuesday, just to see how the market plays out. But as always, let me know what your possible plays are. What stocks are you looking at for this coming week? Are you going to play it safe, or are you bullish, or you think you're going to be bearish on the financial sector earnings this coming week? Let me know in the comments below. And as always, happy trading.